Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss how investing has evolved over the years. From the notion of partial ownership as an investment, to the first stocks, stock exchanges, and stockbrokers, to the mutual funds and ETFs of today. They consider how incentives influence behavior, and how, in the past, fee structures may have influenced investment professionals to the detriment of the investor. Diversification and asset allocation are paramount when investing. So how do mutual fund and ETF securities help with all this? When looking at managed and pool investments, what components are vital and which aspects are just fancy marketing techniques at play? And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Last week, we talked about some of the investing theories that have come out over the last 90 years, mostly from academic research. And a lot of those theories and that research led to Nobel Prizes for those particular individuals. Today, we're going to be trying to get a little more practical. So what is a little bit of the history of implementing some of these investing strategies? So how did people take those newfound knowledge, those profound ideas, and try to implement them for themselves? So we'll start a little farther back, but we'll pretty quickly get back up to the history that you're probably familiar with. And this will help you understand how we got to the current investing environment that we're in today. So Trishul, when you're going back kind of as far as you're aware of, what are the first investments available as not just owning a company per se, but actually being able to invest in a company and then actually having some kind of investing strategy or investment management?
Well, if we look way back in time, apparently there was this notion of selling shares all the way back in the Roman times. So we're talking 2nd century BC. But perhaps, just stepping forward a ways a little bit, something that we might remember from like history school is there used to be trading companies in the 1600s that used to go around on ships, and these used to be actually companies that had shares that were traded across different wealthy individuals, buying shares for a trade route or owning percentages of the goods that went across. One of the main companies of that time was the Dutch East India Trading Company. And if my memory recalls correctly, I think this is probably one of the largest companies that ever existed if you account for, just inflation and bring that to today's dollars. But the notion is this company was actually the first official stock that traded in the Amsterdam Stock Exchange, which is the first official stock market in 1602.
That's what I thought you were going to start with. I didn't know it went back to Rome. I thought you were going to start with the Dutch East India Company and I think there were a couple other, there's a British and I think a few other East India trading companies.
Right. Those were probably the ones that were probably more familiar today in today's terms, but there has been some notion of trading and holding shares. In fact, there's even some notion that the ability to invest in general started back in like 1700 BC with the Code of Hammurabi, where you had these old civilizations and people actually put up collateral to be invested. Basically, they put up land so that people could use that land to make more goods, like, grow cattle, grow sheep or whatever. You probably don't grow sheep, do you?
I think you raise sheep and cattle, you grow crops.
Right. I wouldn't be a good farmer / agriculturalist.
also because I think ranchers grow, ranchers raise animals, farmers grow crops.
I'm clearly out of my domain.
Okay, let's get back to stocks.
Right. So stocks in general, though, actually in the United States, the New York Stock Exchange is from the late 1700s. So that's quite a while ago, maybe a decade or two after the country itself was founded. 1792, the New York Stock Exchange opened its doors. And they only just had a handful of things going on, but apparently you could do some trading all the way back then.
Okay, so stocks have been around. The idea of partial ownership or investing has been around for multiple millennia. Stocks as an investment, as the way they're organized, the way we think of them today, have been around for a few hundred years. Stock exchanges about the same time. So what about kind of strategies related to investing? Because it sounds just that there's no particular strategy because there's only a few companies you can buy. So it's either you are investing in this other company or you're using your money for something else you get to do yourself with.
Right. And that's where this concept of a stockbroker kind of came up. This middleman who basically was conducting these transactions of connecting the buyers to the sellers. And the stockbrokers would, from time to time, be able to provide advice in terms of telling a given client, well, we see that this stock is doing well. How about you get in on it, and so on. So it's kind of informal, but it's a way to kind of get advice and put your money to work if you have the means to do so.
Okay. So we have the New York Stock Exchange from 1792. We have the Amsterdam Stock Exchange. I know we had talked about last week, very interested idea that railroad stocks in the late 1800s becoming very popular. In fact, they were so popular that there were significant fraud concerns. People would sell stocks in a company that didn't exist, which was kind of the first financial services issue that consumers had to deal with. That really, it's not the greatest start for our industry if you were to think of all the issues we still deal with today. So Congress created the SEC, the Securities Act, Security Exchange Act in 1933 and 1934. And we started to get some research on stocks as they had to actually prove that they were a viable company. So is that about when we saw some of these first investing companies?
Yeah, for example, the ability to buy a collection or a basket of stocks known as a mutual fund. And if we're talking about stocks that might be considered part of the broad market, well, the first one might be considered the Wellington Fund, which is the oldest surviving mutual funds, one of the oldest ones. And this was started in the late 1920s, around 1928.
Oh, so before the SEC was created.
It was before that there was a good amount of regulation that was put in place, because as we know, what kind of happened around this period is we had the Great Depression, which was perhaps foreshadowed by a lot of these investing schemes that started to pop up and a lot of people piling in, and basically a boom and then a bust.
Okay, so it was, and actually that's probably we saw the market crash in 29 was people trading stocks, even if they were legitimate companies, without understanding what they were buying, without having any kind of disclosures or prospectus. And so do you happen to know was there a trust level, just the idea of hiring the Wellington Fund provided a level of due diligence that the government had not stepped in to provide yet?
I'm not sure about the specifics, but I think you're right on in terms of the high level notion, because you want to put your capital to work with somebody you trust. And Wellington was backed by a few high level players like Walter Morgan. And the notion is basically you have a company where a lot of people are putting their money to work. And initially there wasn't too much regulation, but soon after, we mentioned this in the last episode, in 1933, the government said we should probably regulate these things, these securities, and provide some foundation for how they're displayed. And then 1934, we should probably regulate the actual exchanges that these securities trade on. And then in 1940, they said, well, we should probably also regulate the actual companies that are providing these professional investment products like mutual funds and so on.
Okay, so when I hear someone say a 40 Act mutual fund, this is talking about the Investment Company Act of 1940. So this is after the Securities Act and after the Securities Exchange Act. This was the specific act to regulate investment companies, including mutual funds. So it's not just the stocks themselves are now viable, but it's the company that allows regular people to pool their dollars and invest in those stocks is now being regulated as of 1940.
Yeah, that's about right. So prior to that, you probably had investment partnerships where you had just wealthy people pool their money together, and then that pool is managed by some professional who decides to make investment decisions. And frankly, this kind of sounds like today's version of the hedge fund model before the word hedge fund was coined. So one of the first incarnations of this type of vehicle was actually put forward by Benjamin Graham. And we had mentioned Benjamin Graham in the last episode as being like the father of value investing. Well, he had actually pulled together a partnership of money from wealthy individuals. And according to at least Warren Buffett, this may have been one of the first hedge fund vehicles where you have a bunch of wealthy people investing to kind of do better than what they might do on their own.
Applying his research and work in value investing.
Yeah, that's right. And in fact, Buffett ended up cutting his teeth at one of Graham's partnerships. So that's where he kind of got his schooling on the ground. Yeah.
Okay. So the current organization of mutual funds as we know them, there's also things like open-ended funds, closed-end funds, unit investment trusts. Do you want to give just a quick explanation or the difference between an open-end mutual fund and a closed-end mutual fund?
Yeah, sure. Happy to. So the notion about open-ended fund is there's effectively an unlimited number of shares in quotes out there, or an unlimited number of money you can put into it. What basically happens is, let's say the fund currently owns 100 shares of X and 102 shares of Y and 300 shares of Z. Well, that's allocated amongst the 10 or 12 investors. Now, let's say investor 13 comes along. Well, instead of that investor 13 buying some shares that already exist, the mutual fund company will just create grow the pie more and give that new investor a new slice. So basically just create more units. And that's an open-ended fund. So you can just keep adding more and more into the pot by just buying more shares at a proportion relative to the amount of new capital coming in. And same thing as capital leaves. So that's an open-ended fund. Now, a closed-ended fund means you have a fixed number of shares, and the shares, once they're created, they get traded on a secondary exchange. So you have, let's say, 1 million shares of this fund. That fund trades at $10. So $10 million is allocated among these 30 stocks. And if somebody wants in, well, they got to go to the secondary exchange, or basically the stock market, and buy shares from somebody else who wants to sell them. And that price is kind of determined by the stock market itself, meaning it's determined by what market participants think that fair price should be. Whereas with that open-end fund, the price of a given unit is determined by just taking the average price per unit as determined by the average price of those actual assets that mutual fund company holds. So you can figure that out by just looking at all the actual stocks that mutual fund holds and figure out the market value, and then add that all up across all the different companies, and you get something known as the net asset value of the mutual fund.
Okay, so at the open-end mutual fund, when a new investor puts in cash, the mutual fund manager will use that cash to buy more stocks, theoretically in the same proportion that it already had. So it has the same internal asset allocation, use that incoming cash to buy more stocks. With a closed-end mutual fund, there's you could see discrepancies between the NAV, that net asset value, and the current stock price if for some reason outside investors thought that that closed-end fund was likely to go up more than the internal stocks. Maybe there's some kind of betting on the manager's skill aspect. But when a new investor comes into a closed-end fund, another investor has to be getting out or at least selling some shares. So it doesn't necessarily require any internal transactions by a closed-end mutual fund manager. Does that sound right?
Yeah, and just kind of logistically with a open-end fund, what happens there is you kind of place your trades at the end of the day for the next day, and that allows the mutual fund to kind of just gather up all the incoming money and then subtract all the outgoing money and then make their net trades all at once for the following day. Whereas with a closed-end fund, it's the same number of shares that exist, but you can kind of trade it throughout the day as it trades on the exchange, just as the price of, for example, IBM changes throughout the day. Well, throughout the day, the price of that closed-end fund is, changing throughout the day, allowing you to make a trade without waiting till the end of the day. So that is one difference that might be beneficial to some investors.
Okay, so open-end mutual funds, all the transactions occur at the end of the day. Closed-end funds can occur intraday. You'll see kind of intraday volatility like you do for any other stock.
Right.
Okay. Any other investments? What about like a unit investment trust? You'll give a quick explanation of that?
I might actually punt that to you.
Okay. My understanding, I have not invested in it, so my understanding of the unit investment trust goes back to when I was studying for the Series 7. This is a program designed to last 13 months pretty consistently to get long-term capital gains rates, where you put your money in to a unit investment trust. It chooses a basket of securities for you. So there's a manager there. It's going to wait 13 months and then sell out. It's designed to exit out that program so that you're not kind of waiting and seeing if this program will look better moving forward. This has taken on a little bit more of a quantitative style over the last generation or so, where there's now some kind of screening process that all of our information goes into this screening process. We might include some value, might include some momentum, but these programs are trying to predict, here's the stocks that will do better than the general market over the next 13 months, and we're going to end. So it removes some of the feelings related to investing, like, oh, this is a great stock, I love the management, but they just got unlucky this quarter. I'm going to wait it out and see if they can recover, and if my original prediction was true, it just took longer than expected. You might see that with certain active management strategies. With a unit investment trust, it tends to be a very clear strategy from the beginning. Here's the screen based on, maybe they're going to do price to book. Maybe they're going to do like some kind of momentum. Maybe it's a dogs of the Dow kind of thing. If there's have gone down, but they have a good long-term track record, we're expecting some reversion to the mean. So maybe they'll do better over the next 13 months. And then we get out after 13 months. And if it does well, you can reinvest in a new one. You can have these kind of laddered, but it is designed to be just a very specific structure that tries to remove some of the active management components when it comes to kind of the feelings and emotions and what we're trying to predict longer term. So I don't see them used very much, but they were introduced in the same Investment Company Act of 1940.
Yeah, and part of what that Company Act also tried to do is, again, provide some more regulation to the space so that investors had more transparency into what's going on with these types of companies. And that was a good impetus for bringing on regulation, because if somebody's controlling your money and it's a bit opaque, then there could become some concern. However, there is another class of vehicles that I mentioned a bit earlier, and that prides itself on not being transparent, and that's the hedge fund space. So the notion there is you have to be a sophisticated investor to invest in them. So you have to have a certain hurdle of sophistication, typically determined by your net worth or your income. And if you pass that hurdle, you get to put your money in, and for that benefit, you get to hopefully get a higher return, maybe in quotes. And the benefit for the actual managers is they have less regulation to follow, and perhaps they can follow some more sophisticated strategies to perhaps boost your return.
So one of the things I like to point out, this is the argument in favor of an opaque strategy, or especially a strategy that may limit withdrawals, is that open-end mutual funds tend to be influenced by fund flows. So as investors are putting more money into a mutual fund or taking money out of a mutual fund, whether it's the US stock market that they're concerned about, whether they're selling going to cash, whether they want to have less US stock exposure and more bond exposure, there's a variety of reasons. But these fund flows can be large enough to influence the desired strategy of the manager, where the manager may want to hold on to a stock because there's a good long-term potential, but if there's enough fund flows going out, they may be forced to sell just to meet those redemptions and not necessarily to be in line with their desired strategy. With some hedge funds, you also see this with private equity funds, they will restrict redemptions. Sometimes it could be you can only take it out once per quarter. Sometimes it's you can't take it out for the first 2 to 5 years. But the idea is that it could limit the ability of the investor's emotion impacting the manager's strategy. So that's the theoretical reason why you might have these kind of withdrawal restrictions or redemption restrictions. But I don't know, kind of big picture, if I would like to be in favor of more opaqueness. I think in general, more transparency would be the better strategy moving forward.
I agree with that as well, Aaron. One of the mantras that I like to put out there is you should never invest in a strategy that you don't understand. So it's kind of tough if the actual vehicle you invest in is designed to be opaque.
Yeah, and it's even then, kind of, even if there's also a difference between kind of transparency and that control and liquidity. So they might tell you, here's what we're going to do, and here's what you own. But if you can't sell it, if you can't get out, then it's almost a philosophical question of do you still have that asset? If you can't get out, it's similar to that. If a tree falls in the wood and no one hears it, does it make a sound? If you own an asset but you can't actually get the money, is that asset worth anything? It will be worth something in the future, and so we can kind of apply the math to what it has now. But it is a interesting philosophical question of that asset value if you can't actually get to it.
Yeah, I think economics would say that just because it's more illiquid, for that fact alone, it should be worth less. And there's a premium to be had for being able to have quick access to your money. And because there's a illiquidity constraint on capital with hedge funds, then you would expect the returns to be even higher. And that's what kind of gets sold. I think that's also why in the industry, there's a lot of fees that get thrown around for investment products, and hedge funds have for a long time been able to charge probably the highest. A common percentage that you might pay is 2% of assets that you put in. So if you put in $1,000, you would pay 2% of that $1,000 every year. plus 20% of profits. So if it increases by 20%, well, you would pay 20% of that 20% out in profit. So you can see how that this can kind of add up, but hopefully your after-tax total return is higher than you would get from a simpler or less expensive approach.
So does the illiquidity risk and the premium you could expect to receive in exchange for taking on that risk, does that outpace the additional fees that you're paying?
It's a very good question. I've, having been in the industry for some time, it makes me scratch my head a bit. I have noticed a couple of things. I remember seeing some research on a aggregate basis on the performance of hedge funds over time. And the chart I saw that kind of displayed this was a little compelling. So on the y-axis, it had the performance. It was the risk-adjusted performance, but pretty much same thing. And on the x-axis, it had the amount of time that hedge fund was in business, starting at 1 year, 2 year, 3 year, 10 year, and so on. And the first thing that chart showed to me is that if you look at the earlier periods, there were a lot more hedge funds, that were around for 1 year, 2 year, 3 year. And if you look at the later periods, 10, 20, 30 years, you just had a few that hung around. The other thing I noticed is if you look in the earlier periods, 1, 2, 3 years, the risk-adjusted returns were higher. But as you looked further out, that risk-adjusted return started to drop the longer a fund has been in existence.
So it sounds like, one, there's a big survivorship bias impact to returns of hedge funds. And it also sounds like this encourages the managers of these hedge funds to take inordinate amount of risk to either outpace the market by so much that they're going to show those good returns and be able to bring more money in, or fail miserably and they're going to kind of fail so fast that they're out of business within 1 to 3 years.
Bingo. So, yeah, you can imagine this going on in the industry. And what that kind of speaks to is, as you mentioned, survivorship bias, where early on, everybody's looking at these great numbers. And then 3 years out, of course, there are going to be a handful that have pretty good numbers. People pile their money into those handful. And then what seems to happen as those few end up surviving 10, 20 years is their returns end up dropping down to the market average.
So just they did well, brought money in, and then returned to average.
Kind of.
Or they did poorly, failed, and the money was gone.
Yeah, I mentioned some of these concerns with these mega hedge funds that have popped up, like AQR, Bridgewater, and so on. And the notion that you can take a strategy that's supposed to be exclusive and scale it to tens of billions of dollars such that you're doing better than everybody else, it's just kind of hard to believe that's possible. And it might even be true that the evidence says that it's not possible, or it's very unlikely.
This reminds me of sit and go tournaments in poker. Do you play poker at all, Trishul?
Not professionally, and very poorly professionally.
So back in the poker craze, where it was starting to be on ESPN, coincided with me being in college and having plenty of time. So one of the strategies I learned was sit and go tournaments. And this is a great discussion on economics and how incentives change behavior. With a big tournament, the World Series of Poker that you see on TV, the incentive is just kind of last as long as you can. You want to keep getting small growth over time and just last to see if you can get into the top, say, 10 to 30% who will actually get paid out. So sometimes encourages more conservative play. You'll see, I think there's a good story of a professional poker player had pocket aces on the first hand. Someone else went all in, and even though he had pocket aces, it wasn't worth the risk of losing on the first hand because he needs significantly more hands for his skill to play out over time. So big tournaments, you see the incentive is to be a little more conservative. With a sit and go tournament, where now you have 10 people sitting at a table and you play until there's only one person left. And if you run out of money, you move on to go play somewhere else. Now the incentive is to either double your money very quickly, because that larger stack gives you an advantage over the other players throughout the rest of that short tournament, or fail really quickly and move on to the next sit and go tournament. The worst case scenario from their perspective is playing for a long time and getting third or fourth where you don't get paid. They either want to increases the odds of them getting first and second really fast, or they want to get out very quickly. And so it was a lesson that stuck with me of really understanding how incentives influence behavior. And it does sound like that the incentives for hedge funds may be influencing their behavior and might be encouraging them to take on excess risk at the beginning.
Yeah, I think what you said makes a lot of sense. And frankly, that this also happens with mutual funds. So this was studied with actively managed mutual funds as well. Vanguard did a study where they looked at the entire basket of actively managed funds. And they saw the performance actually ended up degrading the higher fees they charged compared to the less fees they charged or the more passive they were. And part of this kind of brings me to another thought that goes to my head when it comes to survivorship bias. And that is, if you're a mutual fund company, well, why not just start 50 funds and then after 3 years, just show the ones that survived, and everybody's going to be like, wow, these people know what they're doing.
The Wyatt Earp effect.
Yeah. And you may have heard this when there was this article I read a couple years ago where there's this strategy for getting football odds. And this is something that you could even pull off to make you sound like the best football game-winning picker of all time. What you do is you send an email to 1,024 random people. And the first week you tell them, I'm going to pick the winning team for, this particular state for the next 10 weeks. And you tell them, okay, you send half the people, this team is going to win. Half the people, this team is going to lose. And of course, at the end of a given week, well, okay, now half the people have gotten the right answer, right? Well, you forget about the other half. They're not important anymore. You take those people who got the right answer, and then the next week you send half the people winning the 2 games in a row and half the people, are not going to win for that second game. And it turns out every week, if you do this for 10 weeks, there's going to be at least one person who you've correctly emailed the correct winning team on a 10-week stretch. And that person is going to pay you thousands of dollars for the next winning team because they think you know how to pick the best team who's going to win in any given week, given your streak. But of course, it's just pure luck.
Yeah. I've seen that. Unfortunately, I have not participated because I've taken a statistics class, but they'll try and say, okay, I've gotten 3 in a row. You can sign up for my newsletter to get the next one. And they'll even, the kind of the good ones that they can track it pretty well, say, yes, I'm not going to do 100%, but I will do something like 70 to 80%, which is enough to make up for the VIG and still profit. And now it's like, okay, as long as you track, as soon as I get 2 wrong, I just stop sending them. I cut off their subscription and stop sending them something. But as long as I you can even incorporate some of those people that you got the second or third one wrong. But if you got 2 correct and 1 wrong, you can still theoretically get them to subscribe because you've met the expectations of getting that 60 to 80% number.
Yeah, so you can see how it's easy to be influenced. And then something we kind of always hear is, what about Warren Buffett? What about Renaissance? What about these people who have consistently beat the market? If they can do it, anybody can. And perhaps a few things to consider based upon that is statistically there has to be some small subset that do better just by random luck alone. And frankly, there's some analysis that actually looked at the numbers and said we should have more Warren Buffetts than we do just by statistics alone. And that's kind of true in the hedge fund space as well. One kind of story I have that relates to my personal background is, so after Warren Buffett went to start Berkshire Hathaway, he actually had an investment partnership similar to how Benjamin Graham did. And he shuffled his clients to a hedge fund that started in 1970 called Rain Caniff. And this hedge fund is actually run since 1970 until now, and it's been one of the best performing hedge funds of all time. In fact, if you look at its performance since 1970 till now, that's 50 years, it's averaged about 13%, 13.4% after fees versus around 11% for the S&P. So there we go. One example of a hedge fund kind of doing better than the broad market over a staggering 50 years. But a few things to realize. So I actually had the opportunity to intern for this fund. I was that was my first experience with hedge funds. So I had a pretty good opportunity to see how this type of strategy works from the inside. And it does make sense. It's the standard Warren Buffett strategy or Benjamin Graham strategy of buying the best companies you have at a lower intrinsic value than what they're trading and holding them for a really long time. But a few things to know. One, again, there should be probably more of these funds than statistically actually exist. And two, it's possible for a fund like this to even get into trouble. In fact, it kind of got knocked on the head after a crash of one of its positions. This is looking back a couple of years. It held a concentrated position in a pharmaceutical company, Valiant. And when Valiant got in trouble for perhaps doing some price manipulation, the stock tanked over 90%. And if you're holding a concentrated position, that idiosyncratic risk that we talked about can really hurt. So if you look at the past 10 years, it's actually underperformed the S&P by a few percent.
So it's almost like if it goes on long enough, and it might take a century, but if it goes on long enough, you think there's a decent possibility that it can get back to average market returns even despite its huge head start?
I think so. Well, a few things though. So its long-term average is still ahead, but if you joined in the later period, which is far more likely, especially with any given fund, it's far more likely you're going to get the later returns than the earlier returns. The tricky part is that a fund of this size, $19-20 billion, is going to have to do a few things to outperform. Either it has to be really concentrated, which it was, and that's why I got hurt by the idiosyncratic risk, or it has to be able to provide some sort of scale to its strategy that if it's diversified enough, it has to find all of these little plays that are doing better that nobody else is seeing. It's kind of hard to do. Now, one thing it kind of has going for itself, at least when I was an intern there, it was the second highest holder of Berkshire Hathaway next to Warren Buffett. And Berkshire itself has been one of the best performing stocks of all time. But I guess full disclosure, do have some shares of Berkshire. And I've mentioned before that there probably might be some structural reasons why Berkshire has this ability to do a little bit better. That's kind of related to tax and its ability to move earnings throughout its conglomerate of holdings, in addition to the great benefit of being able to be Mr. Buffett, meaning being able to access capital and ideas at a level that probably isn't open to your average investor. So there's a few things going for that particular company, but to say that that might persist, who knows?
I think we talked about that in a long ago episode about how Warren Buffett in some respects has transitioned at least parts of his strategy to take advantage of his scale. I remember during the financial crisis, 0809, he provided a private loan to Johnson and Johnson with it's like interest rates above 10%. And it was one of those things of that was not on the market. No one else can do that. He had the cash to be able to make that deal that only existed because of his size and scale and willingness to invest in that way. And that kind of opportunity just doesn't exist for anyone else. So that was a transition that Warren Buffett has made from kind of stock picking early on to, once he got large enough, adjusting his strategy to at the very least be conscious of his scale, if not take advantage of his scale.
Yeah, so something to think about if you're in the active management space of trying to find these winners. They might be either few and far between, or they may not stand the test of time.
Okay. So going back to our discussion on other investment strategies and implementation, kind of after the mutual funds had kind of been around, but I don't think they really got popular until the 80s or so. The idea is that enough regular people were investing in mutual funds with the majority of their investments. It could be tied to also the rise in 401ks about that time and IRAs. But what was the kind of gradual transition from like picking stocks or having a stockbroker to using a mutual fund?
Well, that transition, you're right, probably coincided with the growth in more retail type of products, especially when these retirement advantaged accounts started to pop up in 401k, IRA, Roth, and so on. And over that time, as we transition from like the 60s to the 70s, pioneer in investing, Jack Bogle, put forward a novel idea of having a mutual fund revolving around an index. So the notion of an index had been around since the Dow, I believe, probably late early 1900s, where basically you have an index that tries to track a group of companies. And this was just done to inform individuals of how a group of companies are doing. Initially transportation, and then slowly it graduated towards having more companies, and slowly you had an index of like 90, I think 70 to 90 companies in the original S&P, and that grew to about 500, the S&P 500. But basically this index of companies started to represent how the overall market is doing, and a good average of how well things have done for these companies and thus the market. So what Jack Bogle did is he was originally part of Wellington, that first blended mutual fund that I mentioned in the early 1900s. But in 1970, he kind of stepped away from Wellington to found Vanguard. And what they ended up creating is the first index fund. And the notion there is, instead of figuring out which companies within the S&P 500, for example, were going to be the ones that do well, instead, why not just invest in them all and get that market return? And as we had already started to mention in the last episode, there was a lot of theory starting to bubble up around this time that said this is probably a very sensible way to manage your money. Instead of placing bets and hoping for the best, why not get the average and maybe do better than the rest? I'm not Dr. Seuss. I don't know why that rhymed.
Okay, so it sounds like that's about when we saw a transition from stockbrokers, where investors would have money they want to invest, and they're going to rely on an individual stockbroker to help them choose which stocks to buy, to first just having a greater diversification. So if you have a few $1,000s, and you want to invest, you can't buy every stock. You have to actually pay the stock price, and you probably want to have more than just one share. So you'll have lots of, either, usually 100 is a standard, but you could have an odd lot, and you'll invest your money. And diversification at the first level is just owning more than one stock. So don't put all your eggs in one basket. We're going to own a few different stocks. But depending on how much money you had and how much you had invested specifically in with your stockbroker, you might be holding 12 to 30 positions. That's still relatively concentrated. So the first level sounds like was just moving from these concentrated positions to a more diversified strategy. And like we talked about last week, removing that idiosyncratic risk and only having the general market risk. But you can't do that by owning individual shares because you don't have enough invested. So now you're using mutual funds, and the fact that you can get partial shares and exposure to all of the companies in that mutual fund, which will be probably several hundreds. So the first benefit of mutual funds sounds like it was just the diversification, that your dollars may not have the scale to implement yourself. But the second wave sounds like it was, okay, what are these mutual funds investing in? Do I still pick the manager who's going to pick stocks for me and try to outperform? Or do I try to use a more passive strategy?
Yeah, and that passive strategy, again, had that advantage of having the ability to just have lower costs. Again, if you have a blend of stocks that you're trying to pick on your own, each stock that you try to execute with your broker at that time could have cost a couple $100s, and that can eat into your returns. And then, of course, if you had a professional money manager trying to do the same, yeah, they could use scale, but now you have to pay a team of researchers to figure out which stocks to buy. And these researchers aren't necessarily cheap. They need to do a lot of work to figure out which company is better than the other. They need to understand all of the financials of these companies. They need to actually talk to like the management. They need to fly around to these shops and see how they're operating. They might need to do all levels of analysis that can end up racking up a lot of bills. Whereas with an index fund, you're following a formula that you can kind of write on a napkin saying, okay, divide X by 500 and so on.
Okay, so the other thing I like to point out is we kind of think about how, again, incentives influence behavior. You mentioned that stockbrokers are paid on commission. Their incentive was to recommend a new stock, sell out of the old one and into the new one. And they may not have the research behind it. Maybe they do, to say this is the right time, but there's definitely that financial incentive to encourage new activity. So maybe that's another influence or impact of moving to that mutual fund strategy, where the incentive of the mutual fund manager at the very least is to outperform the market, to try and show I can do this and try to bring in more assets. So they're trying to accumulate assets under management to generate those larger fees and larger revenue. But so moving from stockbroker had both the diversification benefit and also removing that incentive for churning, for buying and selling unnecessarily. So what was the next transition? So you mentioned Vanguard and the index mutual funds. How did we transition from mutual funds to ETFs, to exchange traded funds?
So that would probably be the next incarnation of vehicles. And the first ETF was in the 90s now. So it's essentially just a exchange traded or closed end version of an open-ended index fund. That's probably a logical step to follow. You had closed-end funds, as I mentioned, going back for other reasons. But now you could have a closed-end index fund, and this spawned another renaissance in investing where you had these ETFs or exchange-traded funds. It's just similar to a closed-end mutual fund, where you could have any flavor of strategy, but it's now traded on an exchange. Now, even so, there are actively managed ETFs. They'll charge a higher fee. So the one thing to look for if you're investing in an ETF is the expense ratio. That will be a pretty clear indication of if there's a good amount of active management going on versus whether it's more passive in nature. So you would think ETF would have an expense ratio around 0.8%-ish if it's actively managed on average, but it can go high as a percent or two. Whereas a passively managed index ETF might have a fee that's 1/10 or around 0.08% a year or even less. So there's been a strong race to the bottom when it comes to fees, especially with the automation that we've seen from the 90s onwards. We've also noticed that, frankly, for trading stocks, that those prices have gone down a lot, and the growth of discount brokers over this time. So instead of now calling up your broker, you can do this all online through a transaction on your mobile device, for example. And instead of paying hundreds of dollars, you can pay close to nothing to execute a trade.
Okay, so we've removed stockbrokers because we don't want that incentive of churning stocks, and we are still going through a kind of active versus passive debate. And looking at the active versus passive, just the fees that you're paying for active, it's hard for them to justify, is it worth it? You mentioned exchange traded funds are closed-end funds. So maybe in terms of construction, if I have what was the S&P 100 and is now the S&P 500, I want to kind of invest in 1% of each of the companies of the S&P 100, or 0.2% of each of the companies in the S&P 500. That doesn't necessarily change. Once I've made my investment, I have my initial raise. So that might be why the closed-end structure works well with the ETFs. And so it'll track, the passive strategy might track the NAV versus the price a little bit better. But do you have other thoughts kind of comparing index mutual funds that follow a passive strategy to an exchange traded fund, an ETF that also follows a passive strategy?
So over long periods of time, it shouldn't make that big of a difference. But just the ability to have that extra liquidity in terms of being able to trade in the middle of the day, there's some benefit there. So on the long run, it may not make that big of a difference. But at this point, trades, as I mentioned, for exchange traded products are so cheap to execute. It's one of those things where just, why not just go with the exchange traded version? So that's what I tend to prefer with my clients.
Okay. Some of the things I like to point out, this is, again, I tend to agree the returns are going to be more or less the same, just depending on the expense ratio and what index they're tracking. There are times where with ETFs, you would have to buy whole shares, although that's all just in the last year might be going away, where you can buy partial shares. So with a mutual fund, because you can always buy partial shares of that mutual fund, you can invest $100 per month exactly, or if you want to max out your Roth IRA for the year, $416.67 per month. But with an ETF, you actually kind of have to be aware of the value of how much the share price costs. Mutual funds also do a slightly better job of reinvesting dividends over time. Again, also the most platforms that you would invest an ETF in now will also probably provide that. It's not quite as straightforward. It's actually kind of done by the custodian or the platform, not necessarily the the ETF itself, whereas with the mutual fund, it is being done by the fund itself. But again, these are just logistics issues. Mutual funds, you have to be careful of which share class you're choosing. Some share classes will have a load or internal fees that are being paid to the custodian or whoever's selling the mutual fund to you. ETFs won't have anything like that, but you could have commissions or trading costs. So sometimes if you're trying to rebalance, then with mutual funds, if you're trying to have a certain amount in US large cap stock, US small cap stock, international stocks, emerging markets, some bonds, rebalancing across mutual funds might be slightly easier, especially if you're at the same fund company, and both in terms of application and the kind of dollar for dollar trades and keeping costs and fees down. Sometimes rebalancing across ETFs can be just a slightly more impractical. It requires either you to be aware of, again, those share prices and whole share classes, or using a platform like a Betterment to Wealthfront, they'll do it for you. And so now the fees do get slightly higher for that implementation. But for passive strategies, again, like we talked about last week, the asset allocation is always going to be the big driver of your return. How much you have in stocks versus bonds, how much you have in US versus international, that will determine your rate of return the vast majority. So the actual implementation, whether it's mutual funds or ETFs, I tend to be agnostic about. The fees do matter, though. That's the big thing to pay attention to.
Good stuff, Aaron.
Is there anything else you want to add as we wrap up?
Well, I think at the end of the day, where I kind of land is my thinking in terms of investing early on was in line with the long-term value-oriented kind of Warren Buffett style. But I feel like something that can stand the test of time based upon all the research and kind of being on the inside of hedge funds and all of these sophisticated option strategies and whatnot is it just seems like there's a lot of value to a buy and hold index strategy that is globally diversified. So that's something that I tend to believe in and kind of push forward. I did mention I do have, Berkshire that from like 10 to almost 20 years ago, but the stocks that I do have is such a minority of my overall portfolio. I mentioned this before. It's just more of a reminder that I don't want to trade stocks.
I tend to be kind of agnostic when it comes to implementation. Kind of how is the easiest for the client to help, so that I can help them implement. That tends to win the day for me. The asset allocation, how much of they're allocating to stocks, both domestic and international, small cap versus large cap, how much they're allocating towards bonds, whether it's muni in a taxable account or corporates in a retirement account, international bonds, emerging market bonds. Those are the big drivers. That's the important part of the conversation. The how do we implement has actually become fairly commoditized, that it's just whatever's easiest for you, and let's keep an eye on fees.
Nice. Good stuff.
Well, thank you much for the conversation today, Trishul. I really appreciate it.
Thanks, Aaron. I enjoyed it as well. It looks like we covered a lot of ground and a lot of years. Hopefully it'll provide a good history lesson for some out there that aren't too familiar with this space. So thanks.
Sounds good. Talk to you later.
Okay. Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.